Hello and welcome to KYC. I am Sharad Dubey and with me is Varsha Channani. And you'll be watching a stock which is in focus, that's Metropolis Healthcare, and today's KYC's radar. And of course, a lot of questions regarding this company, why we have taken this company. Is there a business, especially in this lab segment, which people think it's a commodity business, but are there any green shoots to it? But let's just first figure out what are the questions. Why actually want to get them in KYC first of all? We want to know what's the EBIT margin visibility going ahead. Is it going up? Will it sustain? These are the questions we'll be actually asking the management, and also via research, we will be coming with this new numbers. What is the outlook looking like for the radiology segment? Is it a commodity or we see some margin offshoots coming in this sector? Target contribution for TrueHealth, which is their bundling of the products, which of course Varsha will also explain. Outlook on the core diagnostics business, the recent acquisitions, the company has become like an acquisition company as they are acquiring a lot of companies across their verticals. The capex outlook regarding this expansion, where will the funding coming from? Will it always be internal accrual, or in future we can expect some kind of fundraise happening? And are there more acquisitions on the cards? Out of the 6 questions, 3 questions were on acquisitions. You can imagine how important that has become right now. Acquisition, acquisition and acquisition. But what are the other things apart from acquisitions?
Yeah, just starting about what does this company do, I think it's just into diagnostic business. So they own chain of diagnostic center across South Asia, Africa, Middle East, and of course India. Talking about the contribution, the B2C, if I were to talk about, contributes almost 59% to the overall sales, wherein B2C specialty, if you see, contributes 16%, B2C TrueHealth, which is their product, contributes 20%, and B2C revenue from Mumbai contributes almost 13%. Now, talking about B2B, so B2C 59%, B2B 41% contribution, and on that, if you see, the B2B specialty contributes 15% to the overall revenue of B2B, and TrueHealth contributes almost 30% to the overall revenue. Talking about the revenue contribution across geographies. Now, for a diagnostic business, opening a diagnostic chain or diagnostic outlet is very easy, but expanding is very, very difficult. Operating at a pan-India level is one other thing, and that's one of the reasons why all these diagnostic companies grow via acquisition, because they cannot just go and open chains everywhere. So they grow via acquisitions, because to scale a business when it comes to diagnostics is very difficult. So one of the reasons why every company into diagnostic is growing through acquisition. So talking about their geographies, West contributes almost 50% to the overall business. When it comes to South, it contributes 27%. When it comes to East, 4%, and North, 19%. Even though they do have plans to expand their operation when it comes to other geographies, for example, North. Now, talking about how was Q2 FY26, because this is an earnings season, overall inline set of numbers that the company has seen. The revenue growth that you're seeing is led by their organic business, that is Metropolis organic business, and acquisitions. Also, if you see the core diagnostic, now this is actually a very important acquisition for the company, because this has been dragging EBITDA, overall EBITDA level at the group level, but overall in this quarter, the EBITDA margin has inched up because of core diagnostics. EBITDA margin were up to high single digit from a low single digit. Now B2C, if you see, revenue grew 11% year on year. B2B saw growth of almost 14%, while TrueHealth revenue, if you see, grew 21%, which is in line for Q2 FY26. So overall, a good set of numbers, I would say, when it comes to Q2 FY26.
Well, that's pretty interesting, Varsha. But then coming back to the show, why we are doing this KYC, there are important rating parameters which we judge a company on. So let's get the rating parameters in, and after that we'll start the income statement analysis. Varsha will start. The first one is, of course, income statement, balance sheet, cash flow, return ratio. These are the numbers which we'll be looking out and giving the ratings to the company. Also shareholding, street cred, how the stock has performed, valuation, and company's outlook going ahead. These are the 8 parameters where the overall ratings will happen. And to start with, Varsha, income statement, that's the most important thing to actually start with.
Yeah,
so what are you picking up?
Actually, you know, overall, if I were to talk about the income statement, I mean, look at the revenue, 3-year CAGR revenue is just up 3%. There's a reason to that. EBITDA 3-year growth is down 2% and net profit is also down 9%. Now, of course, there's a reason because if you see, there was a time when every diagnostic company grew, which was a COVID time, and FY22 for that matter had been an exceptional year for Metropolis when it comes to the COVID income, contributing almost 16% to the top line in FY22, and non-COVID business also grew a robust 35%. But after that, in FY23, if you see, the number looks subdued now because of the very high base when it comes to FY22, and this is one of the reasons why you're seeing not interesting numbers when it comes to the 3-year CAGR. If you see the EBITDA margins also, over the years they have dipped, because of the raw material inflation, and the post-COVID recovery was overshadowed by the aggressive capacity expansion that the Metropolis has taken. And one of the reasons why you're not seeing that jump in the Metropolis numbers vis-a-vis the other diagnostic, if I were to compare about. So because of the aggressive expansion plans the company has been doing, one of the reasons why you're seeing that subdued numbers overall in the past few years, and that's the reason we have given an neutral rating when it comes to income statement.
Well, yes, income statement has a neutral rating, but Varsha, the balance sheet numbers, those numbers, if you look at the borrowings, you spoke about acquisitions, but you can see net, the borrowings are not very high. And when we speak about a company which is going into a massive expansion, we would be wondering whether debt would be there on the books or not. But if you look at it, the borrowings, it's very less. It's almost only 14 crores. It seems it's like a working capital kind of a debt coming in. And just have a look, 79 odd crores in FY23. So debt reduction has also happened. Book value numbers are largely stable, not much to look at. But interestingly, cash and bank balance, that's still at sizable 49 odd crore rupees. It's not that they are doing acquisitions and entire cash balances is going off. Still, you could say internal accruals is being maintained. That means decent liquidity ratios are there for the company. So from my side, balance sheet will receive a thumbs up.
Talking about the cash flow statement, let's see what that parameter is. So overall, we have given a neutral rating, but nothing dramatic over here. But good thing is the operating cash flow, if you see year on year, it has increased, though a little bit subdued when it comes to FY25. But overall, a good number when it comes to cash flow. The net cash flow negative number that you're seeing is because of the a lot of investments that the company has been doing through acquisitions or opening stores, and one of the reasons why the net cash flow is negative. But overall, a neutral rating, when it comes to cash flow statement.
Well, that's pretty interesting. But return ratios, they are also a function of the expenditures which happen, and the ROC numbers. You look at the numbers, that's been on the higher side. That was 29%. Now that fell to almost 21 odd %. And it's going past the 18% mark, below the 18% mark for FY24. Now, there are 2-3 reasons for it where the ROC numbers on the lower side. First of all, of course, the acquisitions which we are talking about, that is hurting the liquidity numbers also, and because of that, the ROC numbers, they are coming down on the lower side. Also looking at it, this entire trend which is on a falling space, there is a commoditization also happening in the industry. And from the overall, if you look at the long-term picture of the last 4 to 5 odd years, much hasn't happened. Of course, a lot of acquisitions are there and they are baking in a lot of future prospects, but net, the numbers are on the lower side. So I'll give a thumbs down for return ratios.
Well, talking about the shareholding pattern, let's see what that metric is. Overall, a thumbs up. Why? Because if you see, the promoter holding has not gone down. It's like mere 49%. Though FII's holding has gone down, but if you see the DIIs, they've increased their stake, and quite a decent one, from 25% to 33%. So not much negative happening when it comes to shareholding pattern, and hence we have given a thumbs up for this metric.
And looking at the street cred, not much to the returns coming in for the shareholders. 1 month has just been flat. 6 months is the only time where 22% returns have been there, and that's also back on the buying coming in from domestic institutions and the acquisition announcements. But for the long-term investors, there's nothing the stock has given. In 5-year performance, just 5% gain. So from my side, it is, you could say, a neutral impact. For long term, it has been on the negative side. Short term, medium term positional bets, 6 months, a good return has come in. So a neutral impact for the street cred.
Talking about valuations, Sharad, if you see overall, if I were to compare it with peers, the valuations are quite, I won't say it is cheap. It's, tuning with when it comes to Dr. Lalpath and Thyrocare. Now, why Vijaya, has got a premium valuation? One of the reasons is if you see the EBITDA margin for Vijaya and compare it with Metropolis and Dr. Lal, the Vijaya margins are very high. Now, of course, because of the high radiology segment that they have or high radiology contribution that the company has, you have a good exposure to radiology. Your margins will be higher, but of course, the return ratio will suppress considering the high capex involved in radiology. But overall, considering with Dr. Lalpath and Thyrocare, the valuations are in par with some of the peers. So we would give a neutral rating when it comes to valuations.
That's pretty interesting. But looking at the outlook, Varsha, it's largely all of them are future driven, and that is being baked in the stock. Over the last 6 months, we saw in the stock prices as well. Not much in the earnings perspective, that was largely in line. But let's look at the outlook, the acquisition pipeline. That's where the street is asking, will there be more inorganic growth opportunities coming in? And now they have changed the definition of what was earlier B2B and B2C business. Now, post that, how the accounting reportage will happen, that is also something which the street will be watching out for. And the organic business strategy will be expanding, the North Indian part, that's also strong comments came in Q2 numbers as well. So company, of course, is much more focused in Western India. So how their expansion happens, especially in the northern belt, that is something the street will be watching out for. And lastly, potential of any new offerings. There are certain new areas which have been picked up, that is genomic AI testing. Of course, these are very niche, but in the future, what's the potential? That's the question we will be actually wondering and asking. But let's just give the entire ratings, how it's actually panned out one by one. Let's just get all of these parameters in. Income statement, Varsha had spoken about earlier, largely neutral, balance sheet strong. Cash flows has been neutral, return ratios on the negative side on acquisitions, shareholding again getting a thumbs up, while street cred and valuations, a very neutral impact coming in when it comes to stock price movement. But the outlook, that is something to watch out for in the street. That's really good. But overall, Varsha, 5 out of 8. That's pretty good.
That's pretty good.
For their company in their industry, the KYC rating, that comes in at 5 out of 8. But now let's get in more details from the management, and joining us is Surendran Chemmenkotil. He's the Managing Director at Metropolis Healthcare. A very good afternoon to you, sir, and season's greetings to the entire team. The first question, of course, is from our side, is the acquisition front. This company has been in the news for so many acquisitions coming in. And if you could just give us a pipeline, a timeline, like how much acquisitions have taken place and which is the time where the incremental benefits will start coming in. We start with that, and then of course Varsha will ask questions on the earnings also. But first, you just want to give a small taste on the acquisitions front.
Very good morning, and good morning to your viewers. So the acquisition, we have done 4 acquisitions in the last 6-7 months. If I start from March onwards, if I look at it, we have done 4 acquisitions, and all the 4 acquisitions put together is contributing to around additional 10-11% of our revenue growth. So we are growing at 23% this year on first half of the year. So, the 11% is the revenue growth out of the 23% is coming because of the acquisitions. Now, acquisition pipeline, see, when we do an acquisition, it takes a lot of efforts to get the companies integrated into Metropolis processes and scheme of things. So maybe the rest of the year, we will leave it to getting these entities that we already acquired into get integrated. And then maybe the new acquisition may be deferred to sometime next year. Now, that's what the current thought process.
Hello, Mr. Chemmenkotil. Varsha this side. Pleasure to have you at NDTV Profit. Talking about the acquisitions, the core diagnostics EBITDA margin increased from low single digit to high single digit this quarter. Just wanted to know what's the outlook there. where you want to take these margins to, and when this will be aligned to Metropolis margin?
Well, so when we acquired Core Diagnostic Workshop, we were at a break even. That's quarter 4 of last financial year. And quarter 1, we got into low single digit margins, and quarter 2, we are at high single digit margins. And by the time we exit this year, we expect to see this close to a double digit margin. So that's what this year's plan. But in about 3 years' time, of 3 years of acquisition, we will be bringing it closer to the company levels of margins. That's the overall plan that we are carrying.
Sir, on the margin front, if I would want to continue, so overall now for next 2 quarters also you will be seeing improvement when it comes to core diagnostics margin, and that will be integrating into Metropolis margins as a whole. So where do you see this EBITDA margin for FY26?
For a full year basis, I think we should come close to a 2-digit number, very high single digit for a full year basis. If I look at for the financial year 26, that could be the projections.
That's pretty interesting, Mr. Chemmenkotil, about the margins front. For FY26, it's been stated it will be close to double digit. But for next 3 years, that's very interesting that the acquisition margins will be equal to the company's margins. And of course, we are talking about the blended margins. But let's ask about the target contribution coming at for the TrueHealth segment. TrueHealth segment is the bundling of the services, which has been announced by the company. It's a new product category for our viewers who are tuning in. But Mr. Chemmenkotil, what would be the growth outlook for this TrueHealth segments, and currently inquiries, how are they actually pacing for these bundled products?
Well, good question. So, as far as TrueHealth is concerned, the definition is illness bundle and the wellness bundle. For example, if a patient walks into my center and asking for, let's say, 2 fever tests, I will offer him a fever panel, which is all, chikungunya, dengue, and any other viral fever, etc. And the consumer chose to accept that as a testing level because he doesn't have to give his sample if the first test say comes negative, and you have to check first for dengue and then for chikungunya. Multiple levels of sample is not required, and that's a benefit the customer gets it apart from the commercial benefit. And then of course a lot of wellness bundles in the last 2-3 quarters. We also bundled a whole lot of vital checking and doctor consultations and a basic radiology, etc., into the TrueHealth packages. That's the reason the TrueHealth packages and the bundle portfolio, you are seeing that the growth of about 21-22% in the first half of the year. And I would believe that the growth in TrueHealth will continue to be 20% plus for the rest of the year as well.
Right. And sir, overall on a blended basis, if I were to ask about considering the expansions that you are doing, and the acquisitions that you are doing, we've seen that subdued growth when it comes to overall at a company level. When can you see that mid-teens type of revenue growth, maybe in FY27 or 28? Any target that you have, the Metropolis will be back to that mid-teens level of growth?
Well, I think at a group level, we are at 23% growth this year, which I believe is a very good momentum that we have picked up, in the first half of the year. And if you're specifically talking about the organic business, which is at 12.5% in the H1 first half of the year. And our estimate for the rest of the year, it would lie around 12 to 13%. And then maybe, we'll start stepping this up as we go forward.
That's pretty interesting, Mr. Chemmenkotil. We spoke about the overall margin setup and how the integrations of the acquisitions are happening. But one more question is there. Of course, the outlook on core diagnostics. This was the recent acquisition coming in as well. You had spoken earlier about a delay in the integration of one of these acquisitions. Is it that acquisition, core diagnostics, or is it different? And just could give us more light on core diagnostics.
See, Core Diagnostics is a big company and, operating across the country. And, the integration would ideally take about 3 to 4 quarters, and we are on course. There is no delay in the acquisition of Core. And maybe towards the end of this year, by the time we get next 2 more quarters, the entire processes, people, system, pricing, etc., everything would have been integrated by the time we close this year.
And also, sir, when it comes to the B2C revenue, which grew almost 11%, can we call this as a soft growth? Because, I mean, you used to grow more than 11% in the past that I've seen.
You're right. Actually, quarter two, the B2C growth could have been better. But I think this year, if you have seen across the industry, not only for Metropolis, you have seen that the fever-related diseases, the vector-borne diseases were far lower than the previous years in quarter two, which is normally a illness season. Maybe a lot of efforts done by the various state governments in terms of improving the sanitization, etc. The overall the health scenario got better, which is in fact the good news as a matter of fact. But I think it have a slight impact on our business. So that's the only reason in quarter two you will see a little bit of softness on the B2C revenue. And I think the walk-ins will continue to happen in the coming quarters, and the B2C will continue to be stronger for us.
Interestingly, Mr. Chemmenkotil, the B2C business, just for both B2B and B2C business, you give the guidance, but hold on to that thought. I also have one more question, because there has been a delay in the monsoon, and we are seeing in a lot of western regions, monsoon is still prevalent, and cases are coming, of weather changes. Are you seeing the B2C inquiries actually, showing strength in the third quarter as well? What are the channel checks suggesting, for the last 1.5 months to 2 odd months? I'm sure some B2C inquiries must have increased.
You see, that's what I said, the rains are there, good rains, and continue to be raining in some part of the country. But the vector-borne diseases are not as, high as what we used to see in the past. Hence, at the end of the day, for diagnostic industries and medical companies, when somebody falls ill, sick, then only the revenues will start coming in, right? Until he's doing a health checkup. So as the vector-borne diseases are dropping this year, and that has got a little bit of impact on the B2C.
And Mr. Chemmenkotil, what would be your guidance for both these businesses, B2B as well as B2C businesses, going ahead?
Well, I think I've given an overall estimate about 12 to 13%, which is a mix for us. Both the engines B2C and B2B are growing almost the similar levels of the company's estimates, about 12 to 13%. Maybe B2C could be a percentage or two higher than the overall company level, and B2B could be a percentage or two lower than the company level.
Also, sir, wanted to ask you about the radiology contribution overall to the business, and is company planning to allocate capex when it comes to radiology, or establishing their own, establishing companies' own diagnostic centers when it comes to radiology? So, any thoughts on that?
So for us, currently the radiology revenue is relatively very small. And we have about 5 cities in which we operate full radiology, which is X-ray, ultrasound, ECG, 2D echo, etc. And only 5 cities with about 35 centers. And for ECG is concerned, we operate across the country. So we have made a very small but very strong beginning. But going forward, we'll definitely want to strengthen this portfolio.
That's pretty interesting on that. But pricing strategies, that is something which we are looking out for. Any kind of price hikes on the cards? I remember there was a lull period around 2 to 3 odd years when last year the price hikes started coming in. On a blended consolidated basis, are we looking at any price hikes? Also, we are at the start of the year in 2026, in the next 1.5 months odd. So we can expect that?
No, well, I think we did the last price increase in January 2025. And I do not see any price increase happening for rest of the financial year for sure.
Right. On to the last question. What is the volume growth expected, sir?
So on an organic basis, I think we have done 6% volume growth in the first half of the year, despite the fever related diseases being lower. So I think the volume growth could be better than these numbers for the rest of the year.
Understood. So 6 to 8%, can we assume a volume growth for FY26?
Around 7% is what we wanted to do. 6-7% is what we thought we could do.
All right. Well, thank you, Mr. Chemmenkotil, for answering all the questions, and all the best for the business.
Thank you very much. Appreciate it.
Well, 6 to 8% of volume growth.
And no price hikes.
And no price hikes. And also, radiology also, they are, gonna do capex.
It's small, but yes,
yes.
Yeah. But let's just get the management key takeaways coming in. There is a kind of a delay in integration of one of the acquisitions. The management has not stated earlier which is the exact company, But yes, there happens. A lot of acquisitions happen. Next 3 years, acquisitions margin will come close to the core business. I think Varsha, he spoke about a double digit also for
Yes,
FY26.
for FY26.
So that means there's an outlook for bullishness when it comes to margins.
So maybe H2 would be much better than H1 when it comes to overall Metropolis, we would say that.
All right. And of course, TrueHealth business we spoke about, a bullish criteria coming in as well. But net positive outlook coming in. Management seems upbeat, and so does our KYC rating. That's enough for the day. Stay tuned to NDTV Profit.